I end up talking, because the Q&A comes that way as well, about CBTL or Smash a little bit more than we need to. But Jollibee. I mean, you saw the ranking, right? Second fastest brand in the QSR space globally, and fifth in terms of strongest brand. So that tells me that the brand awareness and the brand strength is ahead of our distribution today. What do I mean by that? We have literally 100 stores in North America, and it's only 2 countries, so we're not in Mexico yet. So it's US, 72 stores, and 28 stores in Canada. So that's our footprint today, 100% company owned. So we are in 14 states. Now, within the US, the 72 stores, we're about 40% indexed in the state of California, which, by the way, is a very important state for the QSR segment. So nothing wrong with that. But you can already see where I'm getting to. So if we're in 14, the opportunity really is to expand in other states that we currently are not in. So the process that we take, we have moved quite a bit to data-centric analysis, meaning we're using data that other QSRs would use as well, including KFC and Popeyes, because we're talking about Jollibee now, where we've identified the 30 top cities in the U.S. for fried chicken. And the 30 cities that we've identified, we've also identified where we have stores and where we have white space. So that I'm just now looking at the TC, which is transaction count or volume. And that's very important because we want incremental volume to come through either dine-in or through delivery and other off-prem channels that we've been developing. And AC is your average check. And again, as mentioned earlier, we took very moderate price. So in fact, AC is higher or near double what we took as pricing. So this is coming through mix and really good representation of people ordering more as they come into our stores. Our store network, 6,885, which represented 6.3% growth. Down to the bottom left here again, revenues, quarter and full year. I've shared these numbers earlier. Gross profit, you can see again, the leverage coming through, 22.6% growth in gross profit versus 15% in revenue. So that's nice. Shape of the P&L and operating income, which I spoke to as well. So summary on one page, just to make it easier to put all that together. Now, let's move on to trends. So this goes back several years now, as you can see at the bottom, the years and by quarter. There is some seasonality in our business, so I think it's important to understand that as well. But bottom line is we've set a record in terms of quarter, but also in terms of absolute. So this is where we are at the end of the year. And these color-coded trophies represent all-time high or highest for same quarter. Let's get into a little bit of the details of which parts of the business are contributing to this growth. And if I could bring your attention to the full year, I think it's similar pattern. So let's just focus on the full year. System-wide sales, Philippines contributing 17.6% growth to the total growth equation of 16.3, which I shared earlier. And our international business also kept pace at 14.4% system-wide sales growth. And if you look across our regions like China, North America, we split it into our JFC brands, or we call them Asian brands, and Smash Burger. And you can see growth coming from both. And EMEA, we split out Vietnam because it's our largest EMEA market. So EMEA stands for Europe, Middle East, and Asia. And CBTL is coffee, bean, and tea leaf with near 12% system-wide sales. Superfoods is represented by our brand Highland Coffee. And Milksha is our latest acquisition that we did in February 2022. So all of these brands continue to grow. So what that means is same store sales as well as new stores. Thank you, Briggs, for the recognition. The past few months is hard to discuss in details because we have yet to file our disclosure. But specific to anti-American brands in the Philippines, I don't have the data point. I haven't heard anything either, but we are seeing it in the Middle East. Our CBTL business, for whatever reason, is not seen as an American brand, although it started in California. I think it's because it's headquartered in Singapore and it's owned by an Asian player, us. So we've seen significant increase in that business, and it's picking up from the Starbucks of the world. But we haven't seen that data in the Philippines. But that is not to say that boycotts and brand reputation and the rest of it are not real, because we're very conscious about making sure consumers feel good about our brands, and so we'll continue to make tweaks if we need to. But I think Philippines right now is just organic growth. It's just growing as it has been growing, based on first and foremost great leadership. Joseph, who's a family member, he's doing a phenomenal job with the market, and his leadership team is very stable and seasoned. So we're seeing real solid organic growth happening in the Philippines. I'm not sure if that's from any anti-American sentiments, but I think it's coming from proper organic growth with the right strategies being executed. And as a key macro, then we look at the sub-segments of that population, macros and so forth. So by all measures, it is not a priority market. I know it sounds like a very good market because Japan is a great country and we all love to visit Japan and the food scene's great. It's just not for us right now. At the highest disposable income as a percentage spent to our segment. So the eat out, the QSR space. So having said that, I don't know where we're going to end up in terms of number of states, but that process of 30 cities, and sometimes you have multiple cities in a state. That's why I wanted to make that distinction. I think is probably the way we want to go. And then we're going to supplement that with a strong delivery and off-premise, because we may not have stores everywhere, but if our ability to deliver to get to consumers exists, that's an expansion as well. And your question around the 500 stores and whether we're going to beat that or get to target, etc. My answer is it really depends on our ability to shift from being great operators, as I mentioned, we're 100% company owned, to shift to being equally great franchisors. And if you can make that shift and the box economics at a unit level is more superior than a KFC or a Popeyes, then franchisees who are in those 30 big cities, clusters, as we call them, will look at us as a viable option, an alternative. And if they do that, then that 500 number can really explode. So it's really up to us to do a couple of things right. Make sure the menu is relevant for American consumers. Secondly, make sure that the box economics, including the capex to build a store, average daily sales, and so forth, are stronger than the competition. So again, to restate, our focus in China is Chinese cuisine for many reasons. I think that's an opportunity that makes sense. Having said that, Yonghe King is about 80 to 85% of our total store network. So we have just over 500 stores in China, 3 brands, Yonghe King. Then we have a Beijing regional brand called Hangzhou Yun, about 60 stores, and we have 19 Tim Ho Wan restaurants. Now, I like your question about tiering and so forth, because Yonghe, for many years, as it grew, it started with the tier 1. We've now gone into tier 2. So we're now at a place where we can accelerate the growth. So our ambition is to quadruple the footprint in 5 years. So going from 460, around four, let's call it 400-ish stores, to really quadrupling that, in 5 years' time through franchising in tier 3 and 4 and possibly 5 cities. So the expansion that we're going to witness in the next few years is really about getting into more geographies. And the reason for that is the brand is perfect for that. The average price point of the brand is such that it gives you a lot of value for the quality of food. So we do protein, we do starch, we do sauces, we do soups and vegetables. We do all that for roughly around $4 US meals. And that's kind of our sweet spot at the moment. And so that's why we think tier 3, 4s, and 5s make sense, because of the price point and the value play of that brand. But yeah, we're very excited. And there's a lot of menu development to support that as well. But yeah, we love the brand, and we think it'll continue to grow. And by the way, China pre-COVID, until today, we've not funded China. It's all self-funded by the business and the profits it's made in the past.
Next question is from Jen Austria of Manila Standard. Can you share with us details about your planned preferred shares offering in terms of timing and use of proceeds?
Okay, great. So we have filed disclosure on the 8 billion preferred shares. So our current capital structure is such that we have 12 billion preferred shares that has been issued. But when we applied for that a few years back, we had a higher ceiling. Now, of that 12, 3 billion is coming due this year. And earlier I talked about governance and being a good corporate citizen. I think it is our responsibility when it comes due to be refinancing that properly. So we're not going to kick this down the line, but we're going to refinance it. And so that decision means that of the 8 billion, 3 will go to refinance the 3, i.e. repay back the 3, but not lose our leverage in terms of ability to raise capital. The other 5 we will preserve for expansion and growth projects, including growth in Philippines, which has a very good return for us. And we'll taper the growth in international with this funding. But if there's certain very high return, lower risk in our categories that I talked about, that makes sense in terms of growth through bolt-ons, etc., we will possibly look at those opportunities. But it's really, the fund is there to help us grow in the next several years. So we'll be very careful with that money, and we'll make sure that it gets allocated not to expenses, but rather to investments.
All right.
And the timing is this year. Yeah, sorry, I think I may have mentioned. Okay.
Okay, so our next question is a follow-up from Ruel Castro of Malaya. In relation to Meg's questions, what brand or niche are still missing in the company's portfolio that Titan Fund 2 target can fill up? And also, it was reported in March that Jollibee synced in more capital in Tortazo in the US. Can you expound more about the company's view about the Tortazo role in the company's portfolio?
Okay, so 2 questions here. So I'll reiterate the 4 categories that we've been speaking of since last year. They are chicken, and that'll be led by Jollibee. It's better burgers, and that will be led by Smash Burger. And Chinese cuisine, which we spoke of on 2 tiers, one for China, which is Yonghua, and one for global, which is the Tim-O-Wan Chinese cuisine. And then finally, the coffee and tea category, which CBTL right now, it's near 1,200 stores across multiple continents and countries. So these are the 4 categories. We shall stay in these 4 categories as primary focus. So the funds raised really will be to support these categories. So Titan Fund number 2, it will support, again, disclosure limited, but one of those categories. And then the other part of Fund 2 will continue to support the Chinese cuisine category. So there'll be 2 of those 4 categories being supported by this Fund number 2. Nothing has been identified on the Chinese cuisine side. So again, I can speak of Chinese cuisine in that sense because there's no specific brand that's been identified. The other category I mentioned, a specific brand, so you can do process of elimination of has been identified, but I rather wait until we properly disclose before I can share with you which brand that is and which geography that we're investing in. The second question on Tortazo,